Let me just build up introduction to Mark Mazzarella, who'll be joining us here to talk about why considering REITs for real asset exposure. And given, Toby, the moderator extraordinaire, is not coming up, I have to read the bio and an overview for Mark. And, look, he's got an extraordinary amount of experience working in financial services, a lot of experience on modelling, real estate investments, and he's been at Dexus for 11 years now, 2014, in a previous, iteration. And he's also the lead portfolio manager for the Dexus Global REIT Fund and the Dexus Asian REIT Fund. So, he's extraordinarily well credentialed to give us those insights on why considering REITs for real asset exposure. Over to you, Mark.
Well, thanks for that introduction and good afternoon, everyone. Great to be here today to talk about REITs for real asset exposure. It's felt like over many years, especially since COVID, you've needed a hard hat to invest in and even have a look at the sector. But pleasingly, throughout that period, as hopefully I'll touch on, the return of both A-REIT and global REITs have done exactly what you would expect, indeed over a longer period of time. And that's really help investors' portfolios maintain the purchasing power of capital. And the profile of that return, mostly from income, but with capital growth as well. And that really comes down to the premise of the presentation today and REITs for real asset exposure. And I'll hopefully dive into a bit about the fundamentals of the sector, the characteristics of why REITs are a great real asset opportunity, how their drivers of value have been able to contribute to their ability to provide that maintenance of purchasing power and indeed outperform and provide a really attractive total return as well. I'll go through a few of the benefits of active management and of course where we see the most opportunity in the sector, and give you a look under the hood of how we invest for both the Australian and global REIT strategies that we run at Dexus. But I guess first a brief corporate overview. Specialist real asset fund manager platform with a touch over 53 billion in AUM, and that's mainly in real estate, so hard assets in Australia, office buildings, many of which you'll know from the Sydney CBD, as well as some retail properties and of course industrial and infrastructure as well. So we're, I guess, uniquely placed to speak to and invest across that spectrum of real assets where there are a bit of grey areas, indeed emerging a bit more so as investors increasingly allocate to that bucket of real assets. One of the asset classes in particular I always think of is an airport. Many years ago in a former life I valued Sydney Airport and just couldn't believe how much money is made from car parking and retail rents at the terminal, not just access to terminal fees for the airlines. So it's that kind of thing that I guess positions Dexus to be relatively unique to provide some investment outcomes and opportunities there. But the part of the business that I lead is the real estate securities platform within Dexus. We run two principal strategies, a 7-person investment team, most of which are based in Melbourne. And of course, we've got one colleague, a senior portfolio manager in New York City, who covers North America for our global REIT fund coverage. And effectively, we've been managing portfolios for upwards of 20 years plus. The strategies on this page, the A-REIT fund has been in the market just a touch over 16 years, and it's provided for a total return CAGR of 9.7%. And just think of the volatility we've had since the end or the post-GFC period. And 2/3 of that return has been income. And that fund pays a monthly distribution, but it's been able to maintain that purchasing power of capital because of the attributes of the underlying asset class, irrespective of the volatility. And of course, the global REIT fund's been in the market since 2020, launched in the depths of the pandemic and still returned a relatively attractive mid 9% CAGR over that 5-year period, mostly from income, but more so from capital growth. And again, it pays a monthly distribution as well, albeit at a lower yield. So look, our investment philosophy, we're real estate professionals, fundamentally driven. We look for growth at a reasonable price and look to allocate on a relative value basis. We're happy to buy growth insofar as it is able to be accessed at a reasonable price. And where we have a look at the opportunities across the REIT sector from a portfolio perspective of the REITs that we cover, we like to buy relatively attractive on the ingoing. So there'll be some opportunities through this slide deck to touch on how that works a bit more, but effectively we want to buy in the public market what investors have effectively mispriced versus what the private market valuation would be or would suggest it should be. Our objective is effectively to pass on what is, fundamentally an investment in a relatively secure, attractive and indexed income stream underpinned by commercial leases. So many of you will know the profile of leases across property types is very different. Some property types like self-storage have a lease term of, say, a month. It's effectively a hotel for boxes. Whereas on the other end of the spectrum, you might have mobile phone towers and data centres, which can have upwards of 10 to 20-year lease horizons. So whether there's indexation on the way through or market rent reviews on the way through, there's a great and dynamic opportunity to optimise an allocation, respective of where you are in a cycle or a view on a property type and market. And that's where the active management overlay comes through to be able to optimise returns. So in terms of REITs for real asset exposure, look, I've put up on the slide here just, stating the blatant obvious, which is a liquid access to real assets. These REITs are publicly traded on developed market exchanges and effectively give access to the highest quality physical real estate portfolios that are assembled on earth, managed by some of the most highly credentialed and often specialised management teams. And effectively post-GFC, and indeed more recently, we've seen the capital wrapper that these portfolios are effectively made up of managed incredibly defensively with gearing levels that are, around 30% and indeed less, with maturities and hedging profiles that mean that the fixed cost of their debt expense is effectively marked to market, and there's limited floating rate exposure, and the issues of the GFC are effectively, a lesson hard learned but long remembered. If I was giving this presentation 16 years ago, we might have seen gearing levels at upwards of 50%, and only one source of debt being CBA in Australia, and we all know how that sort of ended. But now the REITs are much better capitalised, and capital management is absolutely at the forefront. And then, of course, access to sectors that we don't necessarily get access to in the A-REIT space, but where we can get a relatively risk-managed exposure to some pretty powerful secular trends. Data centres being one. We don't know which large language model is going to be the winner, but we do know whoever does, and the flow-on effects to the use cases for AI, inferencing and things like that will need to take place in a data centre. So we're still quite bullish on the data centre space, and it might make up about 10% of our global fund. Similarly, on the other side of having a look at where there's some pretty solid supply-demand fundamentals driving that rental tension, seniors living in North America and indeed Europe as well, the ageing population, but also the supply-demand imbalance that was effectively perpetuated through COVID and more recently with the barriers to development from both financing and construction costs. So look, what is a real asset? Look, the underlying value is inextricably linked to its physical use. And, real estate, which I've spoken of, land value and depreciating buildings, effectively. Infrastructure is, very much a specialised asset class that is, either concession or contract based or a take or pay type contract. We've put an airport up there for a bit of an illustration there as well. And of course, commodities, which is often the most volatile source of real asset exposure, but the purest pass-through mechanism or asset class for inflation, given, of course, commodity price moves are incredibly volatile as well. So real asset qualities that drive real estate returns. Look, I won't go into detail on the valuation methodologies, but it's effectively top-line income discounted on a cash flow basis or indeed capitalised at a yield to maturity, which is a cap rate, and that's almost an all-risk yield. So as the top-line income grows with indexation, mark-to-market of rent in the lease contracts, that valuation can increase if rates remain stable and the cost of capital remains relatively certain. Replacement cost is also a relatively pervasive method to check valuations, and it can often be the anchor or the magnet for value given the input costs of labour and indeed the physical goods. So it's often a big driver of why, say, real estate values are often quoted relative to replacement costs as a check to valuation, and that can often be a signal as to whether there will be a supply wave coming or not. And right now, you might hear or see in the market that there's a lot of office buildings that are vacant, but there is really a gap, particularly in Sydney, over the next 3 to 4 years, where the economics of a new development are just really, really difficult to hurdle. So there will be a lack of supply, and then, like any cycle, that will then unwind and become pretty attractive for certain landlords of certain assets. So that's one example of the cycle. But I guess irrespective of that, you can also have a look at understanding the underlying asset class in a bit more detail, and indeed the differences between each asset type and how the duration of leases gives access to market rental dynamics. So look, I mentioned hotels and self-storage as being, the hotel for boxes. Short lease terms, that's why if inflation is relatively high and the demand, supply and balance is in favour of landlords, with shorter duration leases, you've got an opportunity to reset rents quicker and keep that top line driver of the value equation in income ticking along and maintaining value and the purchasing power of capital. Conversely, if you've got long duration assets, it looks a little bit more like a fixed income product, and you can't get that market rent review or access to it, you've got to essentially sign up for a CPI type or fixed rent review mechanism per annum. It's a bit more difficult to keep pace with inflation. So at certain periods in cycles, there's an opportunity for active management to access those market sectors where the equation is in favour of a better relative forward-looking return. This is probably one of my favourite slides from the post-COVID era, and it just basically goes through and has a look at, okay, if we have a look at what REIT returns have done over the last 12 months, lined up with inflation over the same period, you can see that inflation is usually within the bounds, unsurprisingly, targeted by central banks. So within that 2 to 3% range, effectively that's where the most dots are. And in that scenario, REITs typically perform relatively well, a relatively attractive absolute return, anywhere between 8 to 12% through cycle, mostly from income, little bit of capital growth on top. What we've seen over the most recent post-COVID years is that there's been a spike in inflation, and that's corresponded with a relative downdraw or decline in REIT returns over some periods, but then a reversion back up. So last year, for example, the global REITs in AUD terms were up 12 to 14%. Through a market like a 2022, it was a fairly weak and declining total return outlook where the inflation rate was relatively high and the market moved ahead of rate increases materialising through. This chart here just shows that in a different way, effectively 30 years of data showing that the CAGR of return from global REITs is smack bang in the middle of that 8 to 10 to 12% total return range, and well ahead of inflation on an annualised basis through that journey there. Shorter term volatility in inflation obviously whips that around a bit, but over the longer term, that's the type of return you can expect from a liquid real asset class like a REIT. From a portfolio perspective, and I've chosen the US REIT market here because it's the most deep and diverse, you can see there are a number of sectors in here that have a relatively pro-cyclical bias or correlation to GDP, and those that have an anti-cyclical correlation to GDP. So that portfolio benefit of actively optimising your exposure to REITs given where the economic cycle is at, is really valuable. And a practical example of that at the moment is you'll see our portfolio is relatively biased towards seniors living and some segments of retail that are essential. And irrespective of what's happening in the broader economic market or business cycle, the relatively essential dynamics of those two real estate types we see as underpinning the growth in earnings and indeed the valuation for those sectors. Whereas on the flip side, you can see that there's a large correlation between GDP and industrial REITs. Indeed, last year, industrial REITs were some of the worst performing, and that perhaps is a little bit of positioning ahead of a slower GDP outlook, which is absolutely the case for consensus in financial markets at the moment. This slide here is a little bit busy, but it just shows the correlation between sectors, and some have a higher correlation than others. Excuse me. Probably won't surprise you to see that, say, retail and office move relatively close with one another. They're both tethered to the business cycle, economic consumption, retail consumption and business activity driving office and retail returns, but data centres and multifamily are relatively lowly correlated. Both are, pretty essential services, and data centres, of course, not correlated too closely with too many others as well. So the portfolio benefits of optimising an allocation are real. This slide here just basically shows the level of correlation to the asset level returns from global REITs, global infrastructure and commodities against major other asset classes, Aussie equities, US equities, and the REITs really stack up. Indeed, a lower correlation than infrastructure to those major equity markets as well. So look, why active management in REITs? There's definitely an edge in a relatively specialised asset class, and on the right-hand side of that chart, you can see probably two of my colleagues while they're in the States having a look at some really exciting storage assets there, and meeting with some management teams getting driven around, and some racking inside all of the large industrial warehouses. But it's really one of those asset classes you need to know from the bottom up. You need to touch, feel, and know what's happening in those underlying markets. It's a small part of the market. It's only about 2% of the global equities universe, but it still provides for about 2.5 trillion AUD in investable universe, which is excellent because that's a really big sandbox to play in, as my New York colleague loves to say. And ownership is dominated by passive funds and generalists. And there's a relatively low level of analyst coverage when it comes to the small and mid-cap REITs that we've traditionally focused on. But those small and mid-cap REITs, in the large scheme of things, are capitalised at anywhere between 2 to 15 billion AUD in market cap. So we definitely see that there's an opportunity to add value, and one of those pieces of evidence that the REITs are a fertile ground for alpha generation in portfolios is that effectively the dispersion between sectors and markets in the space is quite wide. There's around 40% of performance dispersion between the top performing sector in calendar year 24 and the bottom, and also less than that, but anywhere around 30% between the worst performing market and the best performing one. So there's real opportunity to pick the eyes out of the sector, and these are two opportunities that we were beneficiaries of last year. Both REITs have an enterprise value of anywhere between 6 and 10 billion USD, and both were relatively undercovered. The relative value leg of our process identified that they were mispriced against private market values that were implied, and both were actually taken private last year by private equity at pretty substantial premiums. And it's those kinds of opportunities that we see as relatively fertile given the fair value discount between equities and physical real estate, especially now that we see some catalysts really materialising for outperformance of the sector that I'll speak to in a bit more detail shortly. The other, of course, is that active investment edge relative to the passive or benchmark aware alternatives because of the concentration And you'll see the first, bar on that chart. That totem pole shows the S&P 500 concentration to the Mag 7. And the REIT benchmark index is actually more concentrated than the S&P 500 because one name, Goodman, makes up about 40% of that benchmark. And look, we're benchmark unaware, and we've always had a relative value bias with an income focus. So we're tremendously underweight to Goodman, so we're very happy for our fund investors who have chosen our fund over the alternative. But it just goes to show the traps of blindly hugging an index in a sector like the REITs. Investors are only now understanding what they actually own. And you can see from our active share there that it's relatively high in the REIT space, but even higher in the global space. And that's something we're really focused on maintaining as well. The REIT fund, look, positioning across the portfolio over the last year, and this is to December of 2024, we were relatively value focused and pretty disciplined. And Goodman was one that we're actively declining in our weight and owning more assets that had that relative mispricing and growth at a reasonable price type attributes to their forward-looking return. And they were REITs like a Vicinity in the Fortress Mall space, even a Dexus, relative value, and of course Stockland as well, which is that affordable residential. And we all know there is a affordability issue in Australian residential, and Stockland are definitely playing into that market. On the global side, we're able to get access to some pretty phenomenal secular trends. As I mentioned, technology and data centres, it will be a volatile ride, but those incumbent landlords that have essentially data centre product in market and can take advantage of the demand supply imbalance and that rental tension coming through are printing phenomenal leasing and absorption numbers. We think that there's some good opportunities there that will persist into the medium and longer term as well. Healthcare has really been probably the best source of relative value and return. Demographic tailwinds with some solid fundamental property dynamics driving that supply and demand imbalance. And they've really been able to drive some performance for our funds, and we see that continuing as well. And retail. Retail's been an excellent sector because of that supply-demand imbalance. The cost to construct new product is relatively high. And only here in Australia, I was reading some stats early last week that there's something like 300,000 square metres of retail space that's usually constructed each year, and the forecast outlook is half that. So those dynamics are only going to persist. It's important to be able to pick the eyes out of those. So look, I'll start at the top for our expectations and outlook for the sector. The macro backdrop will drive the bus, but the direction of travel is definitely for one of lower economic and GDP growth and a persistence in the economic, the benefits for a real asset of declining interest rates are likely to continue, with markets pricing anywhere between 70 and 80 basis points of cutting over the next 12 months from both the US Fed and the RBA. Irrespective of that, that's something that a lot of pundits and commentators will talk to as a tailwind, but the REITs just need a certainty in their cost of capital, and pleasingly we know the direction is down, the direction of travel that is, and underwriting of REIT or real estate deals is relatively consistent with an element of certainty because rates have stabilised and they're no longer as volatile as they had been. And that basically is summed up in this chart here, where upwards of 600 individual markets and sectors for commercial real estate were monitored by UBS and CBRE in Europe last year. And you can see that green area of the chart actually shows that yields have been tightening for almost 25% of all of the markets and sectors followed, whereas rolling back a year before that, it was only 1%. And that shows you that there's transactions in the market and there's a certainty in the cost of capital driving that. And the top line income growth is what's giving investors the comfort to underwrite deals at an ingoing valuation that implies a tighter yield. I think many people have spoken about the equities market valuations and perhaps the disconnect between valuations, prices and reality, you can see that post-COVID, effectively, the darker bar on top is the global equity space. The outperformance against the global REITs has been stark and surprised many. And I've been bashing the table with any long-only REIT manager for some time, talking about how valuations are a little bit out of kilter and that elastic band may have stretched a bit too far. I think we've seen that unwind in this year to date, evidenced by the US REITs, which are 70% plus of the global market, are up, or let's call it about 6%, whereas the commensurate S&P 500 is negative over the year to date period. So that rotation and the real asset underpinned return, I guess, fundamental drivers of the REITs is what's contributing to that and likely to continue with a similar volatile backdrop in equities. Another way of, I guess, showing the relative value on offer in the REITs is having a look at the PE discount of the US REIT sector versus the S&P 500. And the three bars on the right there show the last 3 years where the REITs have just traded at a discount for 3 consecutive annual periods. And that hasn't happened before, not since the 3 years preceding the dot-com bubble bursting. And, the period after that were a pretty fertile one for the REITs right up until the GFC, of course. So history obviously doesn't repeat, but it often rhymes. And that's just another figure that shows the relative value on offer in REITs as well. When I first put this chart together over a year ago, it was visible catalysts for REIT outperformance. Now it's been changed to enduring because those catalysts have actually materialised and we can see them still materialising and following through. Every developed market has begun to cut rates. Growth in the economy is being revised downward. And I hazard a guess next time we update this chart, those GDP growth figures that are forecast by UBS using one of their multi-factor models will probably take a leg down. The REIT EPS forecasts may as well, but there'll still be a difference to the upside between the two. And we can see because of those real asset attributes, because of those lease indexation events, because of those structures, because of the ability of REITs to have reset their debt books and take advantage of optimising their releasing outcomes in demand, supply constrained markets. You can see EPS growth an order of magnitude ahead of GDP growth, which to our mind is a fertile top-down signal for REIT returns on a relative basis. So the expectations and opportunity, look, I think I may have mentioned the macro is going to continue to drive the bus. There will be some shorter term volatility, but we take a lot of comfort and we believe investors and portfolio allocators should as well in the underlying real asset drivers of return for the listed REITs, and an understanding of what makes those up will position investors that appreciate that and that can actively allocate to those sectors and markets where that has the best opportunity for attractive relative returns into the future to do quite well. There's a disconnect between listed and unlisted values, and we see that persisting. I think on our numbers that were cut, well, I'd say at the end of last month, we saw anywhere between a 10 and 23% discount to fair value across our models, with no doubt that that's probably changed to the upside given the moves in equity markets over the last week in particular. There might be some risk weightings that we change off the back of that, but that's just an indication of the relative value that we see on offer. And it's probably a good final comment to make on the sector as a relatively attractive source of exposure to real assets in liquid form. So look, conscious of time, but with that, happy to take any questions from the floor.
Do you see, we spoke earlier on in the Milliman session about the risk of recession and whatever. How does that sort of thinking play out in your forward-looking approach to to the REITs market?
Yeah, look, interesting considerations. I feel like we've been pre-positioning in our psychology as investors for a number of years, thinking about recession, and it hasn't happened. It may happen. It's probably been reflected in the bottom up of how our portfolio has been constructed, because as I mentioned, we've probably leaned into those sectors that have the more anti-cyclical exposure to GDP growth and that have more local drivers of their underlying fundamentals. So seniors living, essential services, retail. These are grocery anchored shopping malls that sell items that are, absolutely essential and would probably make up a 2 to 3 time weekly shop for any individual consumer. And we'd be less likely to lean into highly cyclical GDP type real estate sectors like perhaps office and industrial to a degree. There's increasingly been talk about stagflation. That's difficult for real estate investing, but not insurmountable. And there are sectors that give you access to inflationary forces in a low GDP growth environment. It's just really important to be laser focused on the underlying locality and metrics of that market or portfolio.
Thanks, Mark. That was great. In terms of the office, a lot of businesses are encouraging people to come back to work, and then there's a lot of redundancies. How are you seeing that sector? Is it vacancies? Are they increasing? Are they decreasing? And similar with the retail. Are shopping centres struggling now? The consumers not spending as much? How are you seeing the rents, I guess, moving forward for those two sectors?
Yeah, really interesting. I can speak to some Aussie examples because you'll be able to equate it with, maybe your own experience. But definitely here in Sydney, it feels like things are a lot more busier in the CBD. There's a lot more more of a concerted effort to get people back into the office, and that's even came from public institutions. Indeed, I think we've started to see, although it hasn't really been measured as much, is the physical utilisation ticking up a little bit. I think that continues. There's still a lot of vacancy to work through, and with a vacancy rate in the mid-teens, it's nowhere near where it needs to be to get rental tension, which is typically 8 to 10%. And the market that does have that is Brisbane, so there's some rental tension there. I think if you were to have a look at the underlying, look through to the precinct-specific office markets, one like the Central Core here in Sydney, prime buildings, it'd be really tough to get any space. So you'll get rental growth there, you'll get lower incentives, but a market like a Barangaroo will be challenged. Similarly, Docklands in Melbourne, really high vacancy, but when you get up, say, the Paris end closer to Spring Street, it's going to be hard to get any space, so you'll have a better return outcome from assets there. In retail, funny you mentioned that because Westfield, or Scentre Group as they're known, have actually got over 99.4% occupancy, and that's actually ticked up over the last prior corresponding period. And in terms of the rents that they charge their specialty tenants versus the sales, it's at 16% and pre-COVID it was at 18%. But since COVID, the actual sales of those stores has really outpaced rental receipts. So there's a fair bit of room for that rent to catch up. So we're relatively comfortable about that ability to service or grow rents in retail for the best quality shopping centres where tenants absolutely need to be if they're going to still drive sales. And that's why you'll see, I hate the word bifurcation, it's done to death, but the winners will continue to win. Location and quality is really important, and that's across office and, of course, retail.
And of course, near where I live, vicinity are going to put 2,000 houses on top of Warringah Mall.
2,000 more shoppers.
Yes. Yeah, 2,000 more bloody beeline.
Well, great. Thanks so much. And if there's any questions, please reach out.